now. So thanks very much, everyone, for joining today's session. As I say, this is the very latest IRU, Apply and TR European Road Freight Rate Benchmark webinar for Q4 2022. And we'll be taking a deep dive today into what's happening with road freight rates across Europe at the end of 2022 and looking ahead to 2023. I'd like to say it's fantastic to see so many of you on the webinar today. We've got over 300 joining now, and we have over 1,200 individuals registered for the event today. So it's fantastic to be building this community and this engagement with you all today, and we hope you enjoy today's session. A little bit of housekeeping for you. Today's session will last with a presentation for about 30 minutes. We'll run through, first of all, the overall European situation, and then we'll take a closer look at individual lanes. I'm also very pleased to say that today we'll be talking a little bit more about a forecast with some of the very latest data from Apply, and Thomas will be taking us through that at the end of the session. And then, as always, we'll move on to a Q&A session at the end. So please do feel free to enter your questions throughout the course of the webinar in the Q&A app, and we'll do our best to answer as many as we can during the course of the Q&A session to make sure we can answer as many questions as possible. Now, obviously, today's market is a slightly different situation to that which we were seeing predominantly through 2022. We're seeing a lot of volumes softening, and to be honest, we're expecting to see volumes continue to soften as inflation and lower consumer confidence is dampening down overall demand. So we're seeing a bit of a dip there. And actually, this is probably the first webinar we've done since the start of 2020, where we've seen drops in some of the pricing metrics, even in the overall European index. So it's going to be really interesting looking ahead to 2023, how we see that situation playing out. You know, when in 2022 are things likely to 2023, sorry, are things likely to recover in terms of volumes. And obviously we've still got high costs, keeping a relatively low floor on pricing. So we're going to be exploring all of that today. If I'll just introduce you to our panelists today. So I'm Michael Clover, I'm TI's Head of Commercial Development, and I'll be your host for today. I'm also joined by another colleague from TI, Nathaniel Donaldson, who's one of our economic analysts and actually our data team lead. Hello, Nathan.
Hello, everyone. Pleasure to be here.
Thanks, Nathan. So TI will be helping to deliver some of the insight around the road freight market today as we go through some of the data. Then we've also joined by Thomas IRU. He's Chief Executive Officer at Apply. Hello, Thomas.
Hi. Hello, everybody.
Thanks, Thomas. And finally, we've also got Marianne Savoni joining us again, Senior Management of Strategy and Market Intelligence at IRU. So hello, Marianne. For those who don't know the IRU, perhaps you could just give a quick overview of the organisation, and then we'll, as we go on to the methodology in the next slide, I'll allow Thomas to give a quick overview of Apply as well. Go ahead.
Yeah, sure, Michael. Good afternoon to all. So IRU is the World Road Transport Organization. We are representing road transport industry worldwide, and we are counting more than 170 members, national associations, large transport operators, shippers, and service providers.
Thanks, Marianne. And yes, so we'll just introduce you quickly for the methodology now, and Thomas will take you through that. But Thomas, if you'd also like to give a bit of background on Apply as well.
Yeah, thank you. Apply is a company that we created about 5 to 6 years ago now. It's a tech company dedicated to the supply chain industry, and one of our main products that is working quite well right now is this data product that you can see over there and that we'll use. It's a tool that is very briefly connected to carriers, shippers, freight forwarders, and we are gathering data from TMS and from their database, transportation data regarding rates. So we are getting rates data based on real shipments, FTL, LTL, general cargo, temperature control. We have a lot of data, all the data that you can have on the transporter and the variety of data that we can have for the transport industry. But right now and today with our partners and for this webinar and this report, we are focusing on FTL transportation in Europe, general cargo. You will see both spots and contractual prices. And keep in mind that the fuel is included in all this data also. We have the granularity to exclude the fuel, to change the type of transportation, but here we need to have macro data to sense the up and down of the market. So this is what you will see in the next slides and that you will get in the report at the end of the webinar.
Great, thank you, Thomas. That gives you a bit of background. Let's get into some of the analysis now. And our first slide, as always, is focusing on the overall European picture. So we have our index here showing pricing development. And as I mentioned at the start, we're seeing some falls in the spot market over Q4. Nathan, could you take us through the overall European picture?
Yeah, sure. Thank you, Mike. Yeah, so we're seeing the first signs of falls on the spot market. I think we were able to identify some isolated falls in the previous webinar, and now we're seeing that affect the index. So the spot rate index fell 2.4 points, and that's down to 142.1 points. But that still puts it up 18.1 points year on year. In the contract market, rates are showing signs of leveling off, but it did still see a small increase in the latest quarter, so that's up 0.4 points. And that pushes up to a new all-time high of 129.8. So really what we're seeing here is a drop in the demand for European road freight. So following a lackluster demand peak period, it meant reduced pressure on spot rates and allowed some rate falls in that spot market. So really we saw high euro area inflation, and that peaked at 10.6% in October. That was followed by consumer confidence hitting an all-time low in September. So really we're seeing that consumer behaviours have changed, both consumers and producers. High food and energy prices have altered consumer behaviour, and then we're seeing that this is reducing their volume of goods that are demanded and discouraging indulgence, especially over the peak period. Then I would also say we've got high energy prices. The effect of the high energy prices is really affecting the demand from producers in Europe. So we had record high order books in 2022, and now these are starting to fall down. This is coming from a lack of demand for both international and domestic customers for producers. So we've got producers that are now putting less pressure on the spot market as well, but demanding a lower volume of goods. And production in Germany and France is now still below 2019 levels. Then we also have we did actually avoid the severe crisis that we might have expected. So an adjustment in the energy consumption and gas storages reaching capacity has avoided that collapse in demand. So actually we haven't seen as an extreme fall in the rates that it could have been, and we're not expecting to in the new year. But we do still have continued cost pressures. So we're looking at stagnating economy, but then we've also got high diesel prices, which Marianne will take you through, and a continued driver shortage, which also covered in the next few slides. So this means that we're actually looking at a higher cost base. We also then have higher expectations in terms of technology, the demand from both customers in terms of visibility, and then also higher expectations from governments and pressure to improve energy efficiency. So that's going to provide a higher cost base into the new year. So we'll see falls, but the reality is a higher cost base for the environment. And what we're looking at in 2023 now, TI in our November forecast are forecasting a 1.1% growth in the demand for road freight in 23. This is actually down from a 3.4% growth in 22. So stagnating demand, but we're not looking at the severe collapse that could have been the case that we feared last summer.
Yeah, thanks, Dave. I think that's one thing to underline as well. I mean, when we're seeing some of the Q4 results coming out now as well, we're seeing a lot of the transportation and logistics companies also saying that their expectations are for growth to recover in the second half of the year, even though things are pretty suppressed now. So we are looking at an improving picture probably through 2023 as we get through the first half of the year. So thanks for that, Nathan. We'll move on to looking at some of that sort of cost side now and some of the new data from IRU on driver shortages as well. So Marianne, would you just like to talk us through this first slide?
Yeah, thank you, Michael. So indeed here you can see the average European diesel prices along the year, and we can definitely see that on average Q4 2022 diesel prices were still 21% more expensive than the beginning of the year, on January of the last year. And so this kept costs and turn rates high in Q4 2022. We can say that since the war in Ukraine, diesel prices have remained high all year. And definitely, if you want to give a little bit a perspective on the evolution, the US Energy Information Administration forecasts that the crude oil prices are expected to average $83 per barrel in 2023, so down 18% from 2022, as global oil inventories build, putting downward pressure on the crude oil prices for 2023. So this is what we can say to give more also perspective on what could be expected in terms of evolution of then diesel prices at pump for this year.
Yes, thank you, Marianne. Yeah, I mean, that also point just generally rates are still very much up year on year and driven by some of these cost issues. So yeah, that's a pertinent point for pretty much all of the indexes and data sets we're looking at today. Moving on now to looking at open driver positions as well with the very latest data from IRU.
Yeah, so in fact, as a reminder, around 425,000 truck drivers positions were in the field last year. IRU will provide a new update of the driver shortage for 2023 current of this year, and we will come back to you with this update. As you can see on the graph that you have on the slide, the demand for truck drivers has been continuously growing along the year, with the number of truck drivers open positions for key European countries. As you can definitely see that there is a continuous increase and a drop that you can see for December, which is reflecting probably the fall in road transport demand due to the high inflation and the slowing economic growth that we can see in the main European economies. So this is what we can say here. We are monitoring the situation. This is based really on the open positions, and this is a very good indicator to see how the open positions are evolving on a monthly basis. And we compare this with indeed the number of positions and field.
Thanks, Marianne. Yes, very interesting data to see there. And now the next slide, I think we're coming on to maybe one of the driver or how that's really affecting salaries and that sort of thing. So can you take us through this chart?
Yeah, sure. So in fact, not only driver shortage, but also rising driver wages continue to put pressure on the cost and the margins, and as they represent 1/3 of the operating costs. So when you look at the slide, you can see that the truck drivers' average national gross salaries in many European countries are higher than national minimum wage. And when you look at notably Romania, for example, because it is a country where there is the higher driver shortage, the average truck driver's gross salary is much higher than the minimum salary. So in other words, what we can say here that in fact increasing salaries is not the only solution to attract new drivers. And in fact, working conditions improvements and the fact to improve notably the initiative training programs to attract women, young is key. And also improving the safety, the comfort, and the flexibility of the resting areas. And just to finish on this one, we don't have to forget that in very few years, around 1/3 of the truck driver population will retire. And so the rate of young replacement is still too much lower to replace. So it is more and more becoming an emergency to find solutions. And so what we are currently working as IRU, but also the industry globally speaking, is to also try to work on solutions to promote indeed an European framework for the recognition and the exchange of third country drivers, professional driving licenses in outside of Europe. So this is quite a big topic, but it is one of the areas not only attracting young women, but also trying to work on creating a framework to attract also drivers and recognize drivers' profession in third countries outside Europe.
Yes, thanks, Marianne. So in spite of, obviously a lot of good work being done in the market, we can see that this is still a structural problem that we're expecting to have, and even as volumes decline, although that appears from that data from December to have slightly moderated, the issue has still got a huge shortage of drivers there. So very interesting updates on that side of things. So yeah, costs still likely to remain elevated through all of 2023. Okay, we'll pass on now to the next part of the presentation, which is more focused on some of the specific lanes that we're looking at. So we've got the granular data here, looking at, in this case, the Madrid to Paris lane, and we've seen some quite dramatic hikes on this lane in recent quarters, but starting to see a bit of a dip now in the last quarter. Thomas, could you take us through the trends on this lane?
Yes, of course. And indeed, we are starting the next phase of the presentation where we're looking at the lane by lane. Just keep in mind also that the last slide of the presentation will be a focus on a specific lane with the last data that we have from the current weeks, and we'll try to have a forecast of what will come with some analytics. But just to go back on this one, so just to remember, on the Q2, Q3 2022, we saw this big spikes in prices, mainly linked to the demand that was quite high on the French side compared to the Spanish one, because mainly inflation was at a 6% level in France, while it was at 10% level in Spain. This has for sure an impact on the demand side. And if we are looking right now at the last quarter, the Q4 2022, here we are seeing a change in the trend. Clearly, the demand in France on December was down about 1 or 2%, 3% if we are looking only at food consumptions. We have a decrease also in the industrial goods that are produced by Spain, so a decrease here about 1% in December. So clearly, we can see it in many countries, but here this is quite striking. Lower demand, lower production, so of course lower demand of transportation. That has an impact on price. We will talk just at the end what might be the following impact. Prices won't go down drastically, but we'll see that later.
Yes, thanks, Thomas. Yeah, very much demand kind of driven situation on that particular lane at the moment. Okay, the next lane that we're looking at will be looking at Warsaw to Duisburg, so Poland, Germany. Nathan, can you take us through this one?
Yeah, sure. Thank you, Michael. So on this one, we've got 3 out of the 4 lanes did increase and continue to increase, reach new all-time highs. We're looking at the head haul into Duisburg. We've got spot rates that fell down to 1,865 euros for average journey, so that's €1.73. That's a 4.2% drop quarter on quarter, but they do still remain up 27.6% year on year. We look at the contract rates on the head haul, they increased 2.1%, so a slight increase quarter on quarter, up to €1.42 per kilometre, and that puts them now up 39.6% year on year. We look now back to the back haul. We've got spot rates that increased 3.2% quarter on quarter to €1.40 per kilometre, and that's up 8.8% year on year. And contract rates increased 2.1% quarter on quarter, up 15.4%, now to €1.11 per kilometre. And what we're really seeing here, especially on the spot rates, is a struggling German economy. So it continues to struggle, is not putting a lot of pressure on the rates. We've got manufacturing that has struggled to recover since the pandemic, and that looks set to continue. The available Q4 data from the Statist shows that manufacturing is still 3.2 points below its 2019 levels, and all the book volumes are falling from their highs in 2022. So they actually dropped 5.5% in November. That's 10 times the expected drop in that month. So this suggests that we're heading in there. This will continue, and the German production and German industry would demand a lower volume of road freight in 23. And now what this has actually reduced the gap between the spot and the contract on this rate as well. So we've seen the gap fall down to 21.8%. So that means spot rates are now 21.8% more expensive than contract into Duisburg. And that's down from 29.9% in the previous quarter. So a quite considerable change there. When we're looking at Poland, we're actually seeing that costs remain high into Warsaw. So the Polish economy has been quite resilient in the face of extreme high rising costs and still continues to demand road freight. So it's pushing up both the spot and the contract. Official data from Poland shows that manufacturing is up 9.7 points versus Q3. So strong growth, recent growth in the Polish industries. And order levels suggest that's going to continue. So order levels from Q4 are up 37.7 points year on year. And that's following a year of growth in order volumes for Polish companies as well. So that's continued demand pressure from the Polish economy for the road freight. What we're seeing, the outlook is reduced pressure from Germany to put less pressure on the spot rates, but we can expect the Polish economy to continue to have pressure, and both of them still face high costs, especially diesel, and the driver shortage, with Polish drivers making up a large percentage of the drivers in the market, will continue to keep rates high with a high cost base and quite an inflexible supply on the lane.
Thanks, Nathan. So interesting to see one of the economies there, certainly in terms of sectors that lead road freight demand, keeping relatively high demand and maybe sustaining prices a bit more than we may be seeing in other lanes this quarter. The last sort of major lane that we're focusing on today is looking at this France, Germany lane here that we're looking at Duisburg, Lille, I think in this case. And so Marianne, do you want to take us through this one?
Yeah, sure. So as you can clearly see on the graph, so on the head hole, so from Duisburg to Lille, so both markets saw rates rise. The contract markets increased 5% quarter on quarter to a journey price of around 749 euro, up 28% year on year. And the spot markets rose 1.2% year on year to reach 846 euro per journey, so representing 15% increase year on year. On the backhaul into Duisburg, contract rates rose to 543 euro, up 6% quarter on quarter, and 60% year on year. And to finish on the spot markets, we can see that the rates fell 10% quarter on quarter, but are still up 10% year on year. So let me share with you some key elements of explanation here. The weak but the stable French demand alongside ongoing limited supply and high costs have kept clearly head haul rates high. The French National Institute of Statistics and Economy Studies shows production up versus 2021, and notably the French machinery production. But the total output is still 3% below 2019 levels, so before the pandemic. On the backhaul, a large 10.24 in the spot market into Germany reduced, as you can clearly see, the gap between the spot and the contract markets to 11.8% down from 32% in Q2. And this is evidence of normalization in the spot markets toward Duisburg. The weak German demand has allowed spot rates to fall. And the Q4 data from the Germany's National Statistics Office shows clear signs of falling German consumption. And notably, if you look at the retail turnover for the food and the beverage, is down 10 points year on year, with notably the household equipment down 9.6 points year on year. So these numbers are reflected in major producers in north of France, reporting poor H2 2022 financials, and notably this is the case of Danone. So the effect is falling road freight demand from major producers as consumers demand a waning volume of goods and reduce the competition for the road freight. So finally, the outlook on this lane is showing a kind of, we can see an upward pressure on rates. However, there is no evidence of demand collapse causing extreme rate falls. And the lowest fuel price that we can see could have the potential to keep cost rates well above the H2 2022 levels.
Thanks, Marianne. Yes, so we'll be returning to look at this lane and the latest data on this later on as well, to see exactly what's going on in January. But we'll turn now to the UK, and we've got an index here looking at some of the international lanes from the UK market. Obviously, UK has been hit fairly hard by the economic situation at the moment. So Nathan, could you take us through what we're seeing here?
Yes, thank you. So during Q4, we saw all indexes for GB international rates fall. If we're looking at the import lanes, we saw contract rates fell 0.5 points quarter on quarter to 135.5 points, and that's now up 5.4 points year on year. Spot rates fell 3.2 points quarter on quarter to 150.7, and that's up 5.1 points year on year. If we look at the export lanes, the contract rates dropped 3.4 points quarter on quarter, down to 129.3. And then that's the contract, sorry, and then the spot rates fell 8.6 points quarter on quarter, but they still remain up 24.5 points year on year. So again, we're seeing we're seeing large falls in demand. We're seeing the demand struggle from the UK economy at the moment in terms of the production and both the consumption. So UK consumers have faced they've faced high inflation rates, which deterred increase in volume consumed of goods, especially food goods. In terms of the manufacturing, UK's manufacturing production index has dropped to its lowest level since May 2009. And that's when excluding the 2 months at the start of lockdown. So it's fallen quite considerably. And UK car production is now at its lowest levels since 1992. The result is smaller volume of demand from UK industries, smaller volume of road freight demanded from UK industries, especially on export lanes in terms of finished goods, but then also on import lanes in terms of immediate goods for the creation and for the inputs of UK manufacturing. The outlook is further falls in production in 2023, with the UK Trade Association expecting a 3.2% fall in output for the UK. So continuing to see falls in the demand of UK road freight and reducing that pressure. Now, diesel prices have also kept the cost base high in Q4. Diesel prices sat 17.4% higher than their January level. And then also a driver shortage continues to be a problem in the UK, with the UK losing over 30,000 HGV drivers in Q1 alone, Q1 of 2022, that is. Brexit was a big problem, caused big disruption in international lanes in the past. While the mile-long queues on the borders have ended, the new reality is increased complexity and increased costs for UK international lanes. And actually, regulation is set to play a major role in 2023 rates as well. So from January 23, the UK Department of Transport will be removing some rights from EU carriers. So the first being the right to conduct cabotage movements when entering the UK unloaded. The second will limit the rights for combined transport abilities for EU member carriers. And the third will remove the rights to triangular traffic without special permits for EU members. So what we can really expect that the new year will come with struggling supply levels for UK road freight, with the higher demands and the higher expectations. So it will restrict supply. And so we're going to have more, not only we're going to have lower pressure from demand, but actually that supply pressure could limit the falls that we see in the UK. In TI's November forecast, we forecast just a 0.3% growth in the demand for road freight from the UK economy, so just avoided contraction, but the picture just continued to worsen for the UK economy.
Gloomy. Lower demand, lower supply, higher costs. That's great. So look at the prospects there. Okay, let's move on. We're looking now at the Germany international export lanes, and we thought this might be an interesting one to include actually, because we tell slightly different story to what we saw on the Germany to Poland lane with the Polish economy's demand for goods, keeping rates relatively high there, and we're seeing most of them ticking up. This different picture now when we're talking about overall German exports lanes as well. So if you can see the quite sizable fall we see on the spot market for rates on German export lanes there, sort of reflecting the lower, higher cost of German manufactured goods as energy costs have gone up, but also just lower demand across Europe for those kind of components and equipment. Really, what we see there. Obviously, as we mentioned earlier, when talking about the German market, we haven't really seen that kind of catastrophic scenario that some people predicted after the Ukrainian invasion in terms of the impact of gas prices and potential gas shortages on the German economy. So things have been sustained at a relatively high level, but obviously with both demand and output still down, we're seeing rates begin to dip there. Nathan's mentioned some of TI's forecasts for Germany. The outlook's all right in terms of overall volumes for the whole of 2023, looking at sort of 0.6% increase in road freight demand in Germany. So we should see later in the year, some of these rates are sustained more by demand. At the moment, quite a lot of these rates are being sustained more by costs than a demand improvement, and we're seeing manufacturing rates in Germany still down, PMI below 50 every month for the last 6 months of 2022, for instance. So yeah, we'd expect the early part of the year rates to continue to soften on this particular lane. Okay, and then we're moving on to looking at Spanish domestic rates here. So this is one of it actually applies indices, not looking at international lanes now, but looking at the domestic side of the market as well. And Marianne's going to take us through this one.
Yeah, thank you, Michael. Clearly here we can see that the Spanish domestic rates increased in both markets, so the spot and the contract, with a 0.5 points quarter-on-quarter increase in the case of the contract markets, and 6.3 points quarter-on-quarter in the spot one. The high fuel prices and the harvest season demand keep spot prices up 14.9 points year-on-year, and contract prices up 35.5 points. So diesel prices have fallen once more in January 2023 of this year, but fuel prices still remain up 21% year-on-year versus last year. So as a result, rates on both lanes remain elevated, and the cost pressure will prevent an extreme drop in Q1 rates for 2023. So as you all know, the government, and Spain is a good example, the government in Spain has indeed implemented fuel discounts, and not only for the individuals, but also and notably for the transport industry. And for the truck drivers, they are still eligible, which is not the case of the individual, with a discount of 20 cents per liter, which is still ongoing since 1st of January, going until 31st of March. And this discount is going to be 10% per liter starting 1st of April, going until the 30th of June. What we can say here is that even with its high inflation and the climate woes during the last year, the Spanish economy doesn't look set for a disastrous 2023. And TI's preliminary forecasts predict that the Spain road freight markets to grow by 2.6% in 2023, faster than Germany, France, or the UK. So the high underlying inflation pressure will remain and limits the private consumption. However, headline inflation has been falling since August. This is what we can see. So meaning that the inflation isn't set to decimate the Spanish demand for goods for 2023. So rates will be heavily dependent on the fuel prices in the country, and it will depend also on the government's willingness to continue to support the transport sector with the continued subsidies.
Thanks, Marianne. Yes, a very interesting situation in Spain there. So now we move on to our last slide, and this one is looking at the sort of higher frequency data from Upply here, and also we're looking to data right up to the end of January now, rather than to the end of December, so we can get a clearer picture of what's been going on in the last few weeks as well. So Thomas, would you like to take us through this?
Yeah, thank you. And I will try also to answer to some of the questions that we receive, because a lot of them are linked to what we will say just now. We choose to add this slide that is quite new. We choose this specific corridor. We can see the same pattern in many corridors in Europe right now. Basically, we saw a big increase in price in last of 2020. 2021 was a big spike, and in the majority of cases, the spot prices were above contracts. This is, for me, the spread between the spot and the contract clearly indicates that there is tensions on the markets. And there was one question regarding is the price is more linked to the cost or the demand, or let's say the offer and the cost or the demand. From my point of view, spot prices are really linked to the demand, because you have kind of shocks in demand. And what we can see in the end of December and the beginning of 2023 is that spot prices are decreasing. The decrease of spot prices is sharper than the one of contracts. And from our point of view, at least from a demand and offer and statistical point of view, it shows that contract prices will decrease in the beginning of the year. They will follow the spot one, from my point of view, but this is the one if I need to pick, let's say one or the other, but it won't be a decrease like we can see on the ocean freight part. Ocean freight was a big spike and a big decrease. Here, from my point of view, the cost of transportation is still very high, the real cost of carriers. The driver shortage is there. It won't be solved in a year. It won't be solved in the following months or quarters. So the pressure on the offer is still here. The pressure on the cost of transportation is still here. So our guess, let's say, is that prices will decrease at the beginning of this year, will stabilize, will try to be more normal, let's say, but won't come back to a price of 2020 or the beginning of 2021. Linked to the costs, but linked also to the fact that there is a pressure on the offer, where we have a driver shortage and where we have a lot of frictions on this road transportation.
Yeah, well, thank you, Thomas, for sharing that. It's really interesting to see some of the really current data that is available from Upply. I think it's interesting also when we think about the conversations having with shippers, transportation companies as well, where the expectation is still that prices will remain elevated, driven by costs. And if looking at that year ahead picture, that those prices will probably remain at a relatively high level as well. And I know lots of budget planning is being done around those prices remaining quite high. So that seems to be the expectation as well, and that's seems to be borne out in the data we're seeing so far. Okay, so the next slide here is on our Q&A session. So we've had quite a lot of questions. I think Thomas has sort of answered a few to some extent in that little bit of discussion there as well. We'll try our best, I think, to answer these questions as much as we can in sort of in groups, really. I mean, the first one that I can spot there, which maybe follows on a bit from what Nathan was saying, is asking, how do you see the evolution on domestic UK rates? And I suppose the short answer to that would be that we would see that on a relatively similar vein as we would see the international market. Demand within the UK is still softening a lot at the moment. And obviously, we've got a real sort of capacity and supply issue, and some of the changes that we see in regulations coming in at the moment are likely to squeeze that supply a little bit. That said, if you think about changing rules on cabotage, it's never been a huge part of the UK market relative to other European road freight markets, so that probably won't have an absolutely huge impact on on the UK market, but we would expect rates on domestic level in the UK to continue to soften, although as always, prices will sort of follow the costs and things like fuel price as well in there. Okay. Let's have a look at some other questions we have here. There's a little question in there, Thomas, about coverage for Scandinavia in terms of applied data. Would you like to comment on that and how the data coverage is developing?
Yes, of course. And we receive also other questions on the coverage that we have. To be transparent, Upply has a very strong coverage in road transportation in Europe. We don't have a perfect coverage, so we don't have all the countries in the same the same weight in the data, but we can give you the information is public. We can just send me an email. You have my email in the chat. We can send you this information regarding Scandinavian countries specifically. This is a part where we have few data. So clearly we are better in Central Europe, Western Europe than in the Scandinavian countries.
Okay, thank you, Thomas. And we have another question here, which is looking on basically looking at the development of volumes by sector. Nathan, would you like to take that one? I think you're muted, Nathan.
Thank you. Yeah, so just to confirm on that one, any demand forecasts or direction on the growth in demand that we've given are aggregate figures. So that's considering both production in terms of producers and consumers demanding the volume of goods and heading into the countries. TI, we do look at vertical sectors, and we actually look at the aggregate. So we look at the logistics size and demand on vertical level, with our automotive numbers set to be released in Q2. We do also provide other levels, so chemical, retail, and pharmaceutical and healthcare to come. But yeah, this is based on the forecast of aggregate demand, but we will be looking into on a logistics level the automotive industry.
Yeah, thanks, Nathan. So yes, all the figures we're looking at here are really just focused on the overall demand for road freight, but it is possible to break that out into different sectors. Marianne, we have a question here which I think you might be in a good position to answer as well, which is asking about the EU block on Russian fuel and how that might affect the market. Would you like to answer that one?
Yeah, sorry, I was on it. Yeah, so we are currently monitoring exactly this situation. What we can definitely say today is that there is a strategy to diversify the countries of countries providers, and notably the most logical suppliers that Europe is looking for in order to balance. Russia is Saudi Arabia, Kuwait, notably, and also India and the US. Less considered as a priority. So this is more the political part I am mentioning here. We need to see then, and maybe it can be part of the next webinar update, how much in terms of this strategy it is having an impact on the prices. But this is definitely what we can say today. There is a clear strategy of diversification to limit the impact on the prices.
Okay, thanks very much, Marianne, for that. Obviously, a few other questions in here about sharing, the insights or more detail. Of course, all the participants for the webinar, you can download the full report covering each of these different lanes and get a bit more detail on the analysis there and some of the figures. But of course, if you do want the underlying data, then please do get in touch with Upply to access that kind of data. Equally, if you have any more questions around regulations or anything that aren't answered today, then do speak to the IRU. And if you want to know more about the development of the wider road freight market, then please do get in touch with TI. I've popped the details for anyone who wants to reach out to any of the parties up there as well. So you can send any other further questions that you do have through. We've still got time for some more questions though. So there is another one here from Kenny Dobson. This one's looking at what's the likelihood of an EU or country level implementation of a California style ban on trucks with high emissions output, say vehicles produced before 2010. Obviously, we've seen there's been a lot of diesel bans within cities, just in general, and that so there is some form for doing this sort of thing. But I don't know, Marianne, if you have a view on banning vehicles before, with certain levels of emissions and the likelihood of that.
Not necessarily on California, but this is something that we can look to bring more details. But yeah, indeed, it is a good question. We can bring this information maybe, or this element of response maybe in the later on, maybe to the person who asked the question directly. We have the contact details, so we can have a look and answer to this question specifically.
Okay, and we have another question here, which is looking at what is your outlook with regards to volumes and contracted or spot rates in Europe on FTL? We've spoken a fair bit about what we expect to see with volumes on this lane. I don't know if anyone has any further views they'd like to share on the outlook for 2023 that haven't already, on looking particularly at the FTL market. Something you might like to comment on, Thomas?
I mean, on my side, on the level of the volumes directly, I don't have a specific comment. I mean, you shared on your side at TI that you were expecting an increase of demand of transportation about 1%, right, for the year to come, for this year, 2023. But my comment will be on the splits between spot and contractual. Today, when we are talking with shippers, if I take a big guess like that, about 75% of the transportation is done in contract way, because we need to have a secure, I mean, shippers need to have a secure contracts for the quarters and years to come. But more and more shippers need spots. The one that are working with all the e-commerce industry, where you can have a very strong peak in demand. The one also that are working with a very high seasonality, spots is more and more used. I mean, this is what we see. Of course, big companies prefer to have a secure contract to have the volumes and to be sure that they have a very stable and robust supply chain. But we see spots more and more today.
Okay, thank you, Thomas. Yes, and we've got a question here. It's asking us about ports and about the effects of strike events, industrial actions, congestion. Nathan, would you like to come in on that one?
Yeah, so I think especially this point in terms of asking about the German ports, I think what we did see last summer is the potential effect for the low supply and capacity on waterways to affect the road freight industry. And I think that's going to happen. It looks like that could happen more often, especially with extreme climate scenarios in Europe. So I think we saw the Rhine and the Po reach record low levels. And there is the likelihood that could happen again, especially with an actual warm winter, low snowfall. Could see that we can expect that to happen again, where it pushes a lot of demand onto road freight as the total logistics capacity falls. So I do believe that is something that we can expect to see again, where we get those spikes, especially will affect the spot market as the demand is pushed from other modes of transport.
Okay, thank you. And so one more question here, just asking whether we see the impact from nearshoring trends on these different lanes yet. That's something which is always quite difficult to break out from the overall set of results, particularly now we've got all the noise about demand falling more generally. So, looking at consumption within the European market and manufacturing output in Europe itself, it can be quite difficult to see within that what impact nearshoring might be having. Certainly we can see that obviously ocean freight import volumes in Q4 are quite severely down than on what they were the year before, and even dropping quarter on quarter as well. So that could be taken as an indication that more goods are being manufactured nearer to home rather than being imported from Asia, for instance, on the Asia to Europe lane. However, of course, it's also very likely that that is just driven by lower demand and orders from the European market to their manufacturing partners in Asia. So it's quite difficult to say. At TI, we do try and do as much as possible tracking sort of supply chain changes and switches in sourcing and manufacturing locations to try and show that. And we do see the beginnings of that, although still not at an absolutely huge scale. But the expectation would be, with everything that's happening in terms of the security issues around supply chains, obviously the risk of having all your eggs in one basket in one country with all the disruption we've seen recently has been shown up as well. So we do expect over the next year or two to start seeing more of an effect from things like nearshoring or ally sourcing on the market, as well as more sort of high-tech manufacturing within end consumer markets, which is more automated as well. But at the moment, it's difficult to say exactly what effect that's having on the market. Right, okay, well, we've reached, it's now 10 to 4, so we've reached, I think, the end of the webinar for today. Thanks very much, everybody, for your questions. Obviously, if you do have further questions, please do get in touch with us using the contact details on your screen. We'll be very happy to carry on the discussion, hear more about different viewpoints on the market as well. So please do get in touch with us. But otherwise, thanks very much for joining us this afternoon. It's always great to have you with us. And thanks very much to Nathan, Marianne and Thomas for all your contributions and answers today. We appreciate that. So thank you and goodbye.